afternoon, ladies and gentlemen. A very warm welcome to Quarter 3 and 9 months FY26 earnings conference call of D Development Engineers Limited. From the senior management, we have with us today Mr. Krishan Lalit Bansal, Promoter, Chairman and Managing Director, and Mr. Brahm Yadav, Chief Financial Officer. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anand Venugopal from Adfactors PR. Thank you, and over to you, Anand.
Thank you, Michelle. Good afternoon, everyone. We welcome you to the Q3 and 9M FY 2026 earnings call of DE Development Engineers Limited. Before we begin the earnings call, I would like to mention that some of the statements made in today's call might be forward-looking in nature, and hence it may involve risks and uncertainties, including those related to the future financial and operating performance. Please bear with us if there is a call drop during the course of the conference call. We will ensure the call is reconnected soon. I will now hand over the call to Mr. Krishan Bansal, sir, to share his views. Over to you, Bansal, sir.
Thank you so much, Anand. Thank you so much. Good afternoon, everyone, and thank you for joining us. I hope all of you have had the opportunity to go through our investor presentation, which has been uploaded on the exchanges. Over the past few quarters, we have been consciously strengthening our core engineering franchise, improving execution intensity, and completing the major building blocks of our growth capex. This phase of investment is now nearing completion, and we are beginning to see its benefits reflect in operating performance, capacity utilization, and margin profile. Importantly, our core business, process piping, manufacturing solutions, heavy fabrication, and others continue to be our main value accretive and margin-driving businesses, and this is clearly reflected in the improvement in our operating performance over the last 9 months. In Q3 FY26, we delivered healthy growth in revenue and EBITDA, driven by strong execution in the core business. While the CFO will walk you through the detailed financials, I would like to highlight that core business EBITDA for 9-month FY26 stood at 129.8 crores, representing a year-on-year growth of 175.5%, driven by better execution, improved utilization, and operating leverage across our facilities. This core business EBITDA excludes the losses from the non-core power segment, which are reflected at the consolidated level. From a broader perspective, the policy and investment environment remains supportive. As highlighted in the recent Union Budget 26-27, the government has maintained a strong focus on capital expenditure, with FY27 capex budgeted to grow by about 11 to 12% over the revised estimate, along with sustained allocations toward infrastructure, transport, energy, and industrial corridors. This is complemented by encouraging trends in our overseas market as well, which form a meaningful part of our core business, where investments in energy, process industries, and infrastructure are also gaining momentum. Together, domestic and international demand drivers are creating a strong multi-year opportunity set for complex core offerings across process piping, manufacturing solutions, heavy fabrication, and other businesses. Strategically, during the quarter, we have further sharpened our focus by clearly segregating the business into core and non-core segments. Our core business comprises process piping, manufacturing solutions, heavy fabrication, and others, which includes our Morpheus acquisition. While the non-core business is the power generation division within the non-core segment, we are actively pivoting towards biomass pellet manufacturing and exploring the inert IT structure to house the additional pellet capacity with the objective of ring-fencing capital and limiting incremental cash outflow from the power segment. This approach is aimed at improving capital efficiency, reducing cash burn in the power business, enhancing integration with our biomass platform, and creating a more sustainable and scalable model over the medium terms. On the execution front, the Anjar facility is now fully operational and is contributing to revenue growth and operating leverage as utilization ramps up. In parallel, our seamless pipe plant is progressing well and is nearing commissioning. As approved by the board, this facility will have an annual capacity of 7,000 tons with a capex of about 90 crores, of which 22.5 crores will be funded through internal accruals. At optimal utilization, we expect this plant to generate peak annual revenue of around 450 crores with an IRR of approximately 30 to 35%, given the high alloy, thick walled, and application critical nature of the product mix. The plant will manufacture thick walled seamless pipes up to 120 mm using alloy and stainless steel grades, catering to critical applications such as large thermal power plants and subsea and other high-spec projects. This is strategically important backward integration initiative that will strengthen our capabilities in high-spec applications, improve supply security, support margins, and reduce lead times. With the current capex cycle nearing completion, we expect better asset turns, stronger cash generation, and a further improvement in return ratios going forward. Looking ahead, we continue to see good demand visibility for our core business, particularly from the power sector, apart from opportunities in oil and gas and process industries, both in India and abroad. With a strong order pipeline, improving operating leverage, and most of our growth capex behind us, we believe it is well positioned to compound profitable growth and create sustained long-term value for our stakeholders. Now I invite our CFO, Mr. Brahm Yadav, to help us through the financial highlights of the quarter in December. Over to Mr. Brahm Yadav, please.
Thank you, sir. Good afternoon to everyone on this call. I will now take you through our financial performance for Q3 and 9-month FY26. During the quarter, we reported a strong growth on all our key performance parameters, like revenue from operation for the Q3 stood at 286.7 crore, registering a year-on-year growth of 77%, and for 9 months stood at 780.4 crore in INR, registering a year-on-year growth of 44.3%. Our operating EBITDA for Q3 was rupees 47.6 crore, up by 740.9% on a year-on-year basis, driven by a low base in the previous year and strong operating leverage this quarter. For the 9-month figures for the operating EBITDA stood at rupees 127.6 crore, which is up by 111.7% year-on-year basis. Operating EBITDA margin improved to 16.6% in Q3 FY26 as compared to 3.5% in Q3 FY25 and stood at 16.3% for 9 months as well, up 11.1% from corresponding period last year. Therefore, consolidated operating EBITDA is 127.57 crore for the 9 months, which is after adjusting one-time hit of 4.2 crore with respect to labor code impact, and along with 14.64 crore operating EBITDA loss in the non-core business, which is power generation division. If we exclude these impact, both of them 18.84 crore. If we exclude, our operating EBITDA would have been 146.4 crore instead of 127.5 crore. Similarly, the operating EBITDA margin improved to 19.6% for 9 months FY26. Now, the overall picture, profit after tax is for Q3 FY26 18.6 crore, while 9 months FY26 PAT stood at 49.5 crore, reflecting a return to profitability on a quarterly basis and a year-on-year growth of 308.2% for 9 month period. This performance was primarily driven by operating leverage, supported by higher execution momentum and improved capacity utilization. Friends, lastly, I would to highlight that our robust order book indicates strong multi-year revenue visibility. We remain committed to execute key projects to build a project portfolio that supports our profit and expanding our footprints across relevant markets. With this, I would like to open the question answer and look forward to receiving your question. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask questions may please press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. You may please press star and one to ask questions. The first question is from the line of Kamlesh Bagmar from Lotus Asset Managers. Please go ahead.
Yeah, thanks for the opportunity and excellent performance over the last couple of quarters, sir. So just one question, just wanted to understand that as we highlighted in our opening remarks that there was roughly around 14.5 crore of loss because of or EBITDA pogo because of tariff revision in the power business. So if I see last year, so our revenue contribution from the power business was roughly around 10%, and it was operating at roughly around 20% EBITDA margin. So even if I see this 9 months, so like say assuming 9 to 10% of revenue contribution, like assuming that there has been no tariff revision, even like say 10% would have been the revenue contribution and 20% would have been the margin. So on our overall margins, the impact would not have been more than 20 bps. So we have reported 17.4% margin for business, that is piping and fabrication. So the impact has not been more than 20-30 bps because the revenue contribution of the power business has only been around 10%. And even in the EBITDA, the contribution was roughly around 8 to 9%. So why we are saying that the EBITDA impact is roughly around 14.6 odd crore? So just wanted to understand that.
Brahmji, can you answer or should I?
Yeah, please, sir.
Yeah, I mean, if you can take it, it's good. Otherwise, I will go.
Sir, you can explain.
Thank you, Kamleshji, for your question. I will I will not be able to comment on the exact numbers, but what I would like to say is that one of our plants was earlier operating at the rate of 8.57, and now we are operating it at 3.5 rupees. That means there is a loss of 5 rupees per unit. So that means further, if we are right now booking a revenue of 1.5 crore per month, it would have been around 4 crores in a normal circumstance. It would have been 4 crores. So that means around 2.5 crores rupees loss is coming every month which will directly impact the EBITDA and the PAT only, because all expenses we are incurring on that except for the very little on the fuel saving, because we are running it at slightly lower capacity. Otherwise, all other expenses, everything is going on. And hence, it's a direct impact of almost around, 3 crores or 2.5 crores every month, which is around 22.5 crores in terms of this thing. And if we consider power sector, our power division also, which is in the main company, so there also, we are getting a hit of almost around 1.5 to 2 rupees. So, there also it is the same impact. So, net effect translates to actually 14.3, which is the exact working which we have done on paper. And we can share with you if you want it. There is absolutely nothing hidden in that, because it's very clear, as I have tried to explain, that it is because the tariff revision has been downwards. So, it's the direct impact.
No, I agree, sir, but when we were guiding around 19 to 20% margin before this hit.
Yeah.
So
at that time, full EBITDA was taken. At that time, full tariff margin was taken.
Yeah. So in the core piping business, we are making 17.4% margin, and even
how much?
We are making. So in this 9 months, we have done 17.4% EBITDA margin. So I have doubt on this margin. So have we took that labor code impact in the operating EBITDA, or it is below?
Operating EBITDA only?
No, so 4.5 crore.
Yeah. Let me explain. 4.2 crore is about already included in the operating EBITDA. Already that hit we have taken.
So we have given 45.8 crore of EBITDA. Okay, sir. And if you see the overall EBITDA for this quarter, it is 47.6.
Yeah.
So I want to just ask that, is this 45.8 crore EBITDA, which you have mentioned as the core operating EBITDA, so does it include 4.2 crore of labor code impact or not, sir? Because otherwise when...
Yes, it is already included.
So that's why the whole comparison becomes non-meaningful, because when we compare with the EBITDA, because overall EBITDA doesn't have the impact of labor code, while your core operating EBITDA has the impact of this 4.2 crore.
Pardon?
So when you have given 45.8 crore of EBITDA, core business EBITDA.
Yes.
So does it include the labor code impact or not?
Just a minute. Yeah, it includes.
Okay, so can you tell the figure, what is the, sir, EBITDA, core EBITDA before this labor code impact? Because, sir, I would just ask my total question. Sir, you have given the total EBITDA 47.6 crore, which is before the impact of labor code. And you have given the core EBITDA for your, piping and fabrication, which is 45.8. And if I deduct this 45.8 from 47.6, then the residual EBITDA, which is 1.8, it is for the power business. When we are saying that our power business is making losses, then how can there be the 1.8 crore EBITDA then, positive EBITDA? So that means that in 45.8 crore, we have took the impact of labor code. So it is not comparable. You should have given the EBITDA, which is before the labor code impact in the presentation.
Anyway, sir, if there is any confusion, Kamlesh, if there is any confusion, we will send the revised filing on the stock exchange. But again, let me make it very clear that, our original guidance was 18 to 20%. Without considering the impact of this tariff revision, and at that time there was no thought of that this labor code impact will also come. So even if we exclude this labor code impact, we are absolutely, I'm saying as per the original guidance only, just considering the impact of the power division tariff. So, we have been giving the guidance in all our last 3 calls that, we shall now be doing anything between 16 to 18% considering this particular loss. And we are absolutely on track. As a matter of fact, we are much better than, what we have projected in the last 2 calls on this particular subject.
No, I totally appreciate that. It's more of a data presentation issue. There is nothing.
Data,
no
sir.
No question about
we will
and
we will rectify. We will rectify that. Since there is a change of team, there may be slight issues here and there. And we will rectify that and immediately send a revised filing on the stock exchange today itself.
Also, secondly, now you have highlighted that your core business. So in this 9 months, we have done 17.4 crore EBITDA margin. So now going forward, your seamless will come in and you will have a far better execution as the orders are coming from the power sector. So where do you see our margins? Only on the core business, because power, as you had highlighted, that a lot of things happening there. So going forward in FY27, where do we see our
18 to 20%, sir. As we have been telling, it will be 18 to 20% in this range. There is absolutely no doubt on that. 18 to 20%.
And lastly, sir, what is the commentary on the new order coming in? So what level of orders we are seeing or to book in this particular quarter, sir?
Sir, in this quarter, we are well on track to get many orders. Many bids have been opened and we have been declared L1, and we are not able to disclose it, till we get the formal order. But I can tell you that whatever anticipations, whatever guidances we have given earlier, it stands true. And, many tenders, I will say, that have been opened, and we are L1 in many of those.
Okay. And so what would be the ballpark size of those orders, like say,
maybe 300 to 400. Maybe 300 to 400.
Okay. There we are almost near to L1.
Sir, I'm sorry to interrupt you. Mr. Bagmar, I would request you to kindly rejoin the queue for follow-up questions, please. There are others who are waiting for their turn.
No issue. No.
Thank you so much, sir. Thank you. We'll take the next question from the line of Utkarsh Chanana from SMC Private Wealth. Please go ahead.
Hello, am I audible?
Yes, sir, please. But there is a background noise from your end. I would request you to kindly move to the quieter place, please.
Sure, sir. Good afternoon and congrats for a good performance, sir. I just wanted to ask that why is the current tax in this quarter so low? And for future estimates, can you guide what can be the tax we can assume for our estimates?
Yeah, I could. Brahmi, could you get his question? I think it's related to tax or what?
Pardon? The tax charge this quarter is of 8%.
There is a
Brahmi, you have to answer.
Just a minute. There is a deferred tax as well.
Hello.
Hello.
Yes, sir. So I just wanted to ask that what can be the normalized tax rate we can take for future estimates?
22% plus cess and surcharge. It is 25.17%.
All right, sir. Thank you so much.
Yeah, thank you.
Thank you. A reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Daksh from Nexa Securities. Please go ahead.
Hello.
Daksh, please proceed with your question. I have unmuted your line.
Yes. Good afternoon, sir. So my question is regarding the pellet, which we are going to start from the next quarter. So can you just reiterate on the timeline, and from FY27, will it be EBITDA neutral, or will it still be, there will be some operating losses for the power division?
It will be absolutely EBITDA neutral. It will be absolutely EBITDA neutral. Our pellet plant is about to get commissioned, and the trials are going on. And we may make some sale in the month of March, but the full capacity sales will start maybe in the month of April, and it will be definitely EBITDA neutral. There will not be much gain. There may be still very little gain, but whatever losses we have incurred in this particular year, which is going to be almost 36 crores, will not be there in the coming year.
Okay, sir. Got it. So from quarter 127, we can expect to be...
That's right.
Losses.
I mean, this loss will not be there. You can assume just that this loss will not be there, but there may not be any gain also, much gain also.
Okay. Got it, sir. Thank you.
Thank you. The next question is from the line of Prisha Shah from RS Family Office. Please go ahead.
Hello. Am I audible?
Yes, ma'am, please.
Yes.
Okay. Hi, sir. Good morning. So I have good afternoon. I have a couple of questions. First being, with the 3x revenue growth target which you have given for over 3 to 5 years, so what specific operational efficiencies are being implemented to ensure that our asset turn stays above 3x, 5x range?
Our major Anjar expansion is going to be responsible for that. We shall be doing a lot of, revenue from that particular plant, and at the same time, this being very near to the port, we shall be having a lot of saving in terms of logistics cost. Plus, at the same time, this being an absolutely new setup, which has been set up considering all lean manufacturing principles, we expect a very huge operational leverage also, which is, as a matter of fact, which has started showing in our present results also. And, this plant will be dedicated purely for oil and gas sector and seamless pipe manufacturing business, and our Tatarpur plant, our earlier plant, shall be dedicated to the power business. In power business, we get much higher revenue because of the nature of the work we perform, and that is the basis of reaching 3x level by 30.
Okay, sir. Understood. I have one more question pertaining to industry. So, with the global interest now being focusing on nuclear energy, which is reviving, how is DE utilizing its NPCIL qualified capabilities to secure the larger share of these international piping contracts?
We are already in advanced stage of discussions with NPCL and some private players also who are setting up the plant right now. And, that is our next focus on the business growth. Sometimes people ask that what after, this present cycle of power sector finishes, then, to answer that to everybody is that, we are having lot of focus on diversifying ourselves into nuclear business, into semiconductors business, and, pharma business. That's going to be our next major line of diversifications. Of course, in the piping manufacturing solutions only, nothing special, but, our focus may shift to these particular sectors to a large extent.
Okay, sir. That answers my question. Thank you so much for the opportunity.
Thank you.
Thank you. You may please press star and 1 to ask questions at this time. The next question is from the line of Ripunjay Agarwal from Amar Alliance Equity Research Private Limited. Please go ahead.
Good afternoon, sir.
Good afternoon. Yes, please.
Good afternoon, sir. First of all, I want to congratulate you on an excellent result this quarter. I have few questions pertaining to your business operations. If you may allow, I need to understand the inventory holding. When we see and analyze, the inventory holding comes to a greater period of time as compared to other businesses. Would you please put some light on it, sir? As per our total sales, how much inventory do we need to hold on our stock book, and how does this business operate?
So this question is coming every time, and we are trying to respond it every time also. But again, I will just try to explain you once again. Since we are a project-driven company, so we have to do everything as per the requirement of the projects. They are all 100% tailor-made items which we are making, and they are made as per the customer specs. And we say that it's built to print. It is not a standard product that we will manufacture it, store it, and distribute it through our distributor network. So, whenever we get an order, we have huge amount of specifications involved for each order. And there is a particular vendor list involved that we have to buy the material from a particular vendor only. So, all those things force us that as soon as we get the order, we have to immediately place our orders on our vendors, because many of the items will come from import, and the sea time shipment and the manufacturing time, most of the products will be manufactured against our requirements. We are not sourcing practically anything which are available off the shelf. Our buying from the traders is hardly 1 to 2% of our total buying. The rest every buying is coming from the manufacturing mills, and 50% of it is import also. So, this forces us that, we have to place the orders immediately, and, that creates a situation where we have to hold the inventory as per our, order booking. Our order booking is, let us say, today is around 1,300 crores. So, we have to have an inventory of almost 600, 500 to 500 above just for raw material and other things only. So that is the real cause for our inventory, and this is our nature of business, because we have to follow all the specifications given by the customer, and we have to maintain all the items. We have to get the items first, and then only, we can start manufacturing the spools or the skids, which we are manufacturing. That's the main cause for that. So, you have to consider our inventory not from the previous year sales. You have to consider our inventory considering the present order book.
I got it, sir. So that means the moment we have more of orders in hand, unexecuted order also in hand, that means our inventories are ought to rise, because we need to be ordering, and we need to hold that specific inventory for that particular project or the order in the coming execution cycle. Correct, sir. Absolutely, sir. Okay. Fair enough, sir. Sir, I have another question on your existing debt cycle, sir. Sir, we understand that we came to public, the IPO came in 1.5, 2 years back, and now there was an expansion further. Is there, since we have a good margins on our business, I see we are able to reduce our debt cost or interest cost, it would directly impact the bottom line per se of the business. Is there any vision of the management towards reducing the debt going forward?
Sir, yeah, definitely. Let me again answer that question. Sir, as I just said in my opening remarks, that, our CapEx cycle is almost at the finish line stage. So, whatever CapEx needs to be done, I will say 95 to 98% CapEx will get happened within March of this financial years. And, in the coming years, whatever new CapEx will be there, it will be primarily for maintenance purposes only, which may range between 10 to 15 crores or something like that. So, there is absolutely no new inflow of any term loan or something like that. And, every year we shall be paying almost around 40 crores towards repayment of the debt, which is definitely going to reduce our burden on the this interest cost and other things. Plus, we anticipate that, there will be huge improvement in interest costs because of positive cash flows, which we are expecting in the expecting in H1 of FY27. So, these two factors make us quite upbeat that, we should be able to reduce our financial cost much lower than, what we shall be having in this year.
Thank you so much, sir. I have just one last question, if you could allow me, and that is, sir, in our core business, that is customized piping solution that we call in the investor presentation also, at the optimum utilization of our existing capacity, what should be our top line at that level once we achieve above 90% of the total production capacity, sir?
2,300 to 2,500, sir. 2,300 to 2,500. With the present facilities.
Sure, sir. Sure, sir. Thank you so much, sir, for your valuable time, sir. And all the best for the coming quarter, sir. Thank you.
Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Ram Modi from Prabhudas Leeladhar. Please go ahead.
Hi, sir. Good afternoon. I'm sorry, just joined a little late, but I just wanted to check about our power plants in North. Sir, we have been, I think we lost almost 15, 16 those power plants. So whether we see them getting resolved over next 6 months or it will take a longer time on the litigation side?
Yes, sir, I will say that I will talk first I will talk about our older power plant, which is in the name of Malwa Power Private Limited, in which, our tariff got revised from almost 8.5 to 3.5 rupees. Its, final hearing with the PSERC were held around 10-15 days back, and we are expecting order at any given time. And, again, I will say that in that order, we will not definitely get 100% relief, but, whatever relief we are expecting is that, it should be at par with the tariff which we are getting at Power Division, where it will become sort of a cash neutral thing. There will not be any further drainage of cash from the operation of the power plant if just by getting this new tariff order. But, again, as we have been telling, to mitigate that situation, we have already put a pellet manufacturing unit for biomass pellets, and it's under commissioning, and we may be declaring its COD very shortly. So, with that in place, definitely, whatever was the negative impact, that will be removed altogether. And we may not be earning very high income in that, but it will not be a cash drain.
Okay. And on the second power plant, sir?
Same situation I'm telling you, because in the second system, the tariff was revised to 5.87 or something like that, for which we have already filed our appeal with the High Court. It is still to be heard. So, we are not sure when that outcome will come. But what I'm trying to say is that, with the tariff of this 5.8, and if we get a similar tariff of, let us say, 5.5 or something for the Malwa Power, and with the commissioning of the pellet plant, so, we shall be cash neutral, or we shall be EBITDA neutral from this particular division. And, whatever loss we are going to incur in this particular financial year, which is around 36 crores, will not happen in the FY27 at all.
Mm-hmm. But I'm just lastly, sir, on this itself, sorry for extending this, but if suppose the husk or those prices move up or down, whether this 5 rupee 80 paisa production cost will remain relatively stable for us, because again this will be a long-term PPA which will be signing with the Punjab Electricity Board.
So we are practically not using any husk. We are using paddy straw, for which the price is not likely to vary much. And, that much escalation also we get, in the PPA. So since we are not using paddy husk, so, we are quite well insulated from the price escalation since we are using only paddy straw.
Okay. Because I think this year our P&L actually got significantly drained because of this itself, power plant itself.
Yeah, I am telling you around 36 crores is the drain, right? This year, in full year, this much will be the total drain.
Okay. And sir, secondly, on our guidance on the year-end powers, the order book still remains the same, or we are still seeing some delays on that?
No, we are absolutely on track, sir. We are absolutely on track. Since you joined late, I tried to explain earlier.
I take it from the transcripts, so no need for repeating. Sorry.
Yeah, I have already told on that. We are well on track, sir. I will just tell that we are well on track.
Okay. Thanks a lot, sir.
Thank you.
Thank you. Before we take the next question, a reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Prashant, an individual investor. Please go ahead.
Hello, am I audible?
Yes, you're audible.
Yeah, thanks for the opportunity. I have a couple of questions. Actually, if I look at slide number 15 of your presentation, you have it is mentioned that the order book is 1303 crore as of 31st December 25. And there is a domestic and an export split also given. If I want, could you please break it down into how much is PSU and how much is non-PSU split of this order book?
Sir, that is difficult to answer immediately, but in the coming year, a lot of PSU business will be there, which may be almost around, domestic revenue. It may be around 40 to 60% of the domestic revenue may come from PSUs only in the coming year.
Okay,
but it's a ballpark figure. I'm just telling you from my mind. Otherwise, if detail is to be required, we have to work it out.
So, is it that, export, most of the orders is from private players?
Export is all private players only. Export is always from private players.
Okay. And to one of the earlier questions, you had mentioned that inventory should be looked in relation to the order book on hand and not the past sales.
Right.
Yeah.
Yeah.
In that case, my question is, would it be normal or is it an industry trend that we would also get, since this involves a large amount of specific procurement, do we also get some advance for material purchase from the customer, or it has to be
sometimes we get, sir, sometimes we do not get, particularly from companies like BHEL we do not get, but from others we get it against bank guarantees. But it's very, very limited amount, sir. It doesn't fill our hunger, but whatever we get, that's good. And then it's the problem of our business, or whatever you call that.
Okay. And just from we are manufacturing. We are procuring pipes for fabrication. In terms of the feedback or the conference calls of the pipe manufacturers, they say that it is a very soft market, and they have to extend a good amount of credit to maintain sales. So other way around, since we are consumers, are we getting that benefit? How do you see the input cost trend and the credit terms, and how will it help us in managing working capital?
So, as I'm telling you, when we are talking to the mills, we have to pay them upfront. They do not give any leverage. The maximum leverage they give us is the LC, which they can extend up to 30 days or something like that, but nothing beyond that. But if we are buying it from traders, we do get some credit, 30 to 60 days. There's nothing beyond that, actually. But as far as the price trend is concerned, there is a little bit upward trend right now. But I don't know whether you have been attending the previous calls or not. Our stand on that is that we remain primarily insulated because we order the material almost immediately after receipt of the orders. So if we get the new order now, let's say if it has if it was previously quoted, it may have a very little impact, but it is not going to hurt us in the long run.
Okay. So just to understand, the moment we get the order, in the back-to-back, we place an order for our inputs.
That's it.
But at the time of placing order, do we have to make the payment, or do we make the payment at the time of when we take the delivery, which can be, 1 quarter?
That's against delivery only. That is against delivery only, but sometimes we have to pay the advance.
Okay. And on the fabrication side, one of your competitors has mentioned they are getting a large amount of business from heat exchangers. So is that addressable segment for us, or we are not focusing on that as of now?
No. We are not into that industry. It's a specialized industry, so we are not into that. Absolutely, we are just our core business will remain piping manufacturing and piping solutions only. We are not into heat exchangers.
Okay, so the fabrication basically will address which piping markets only, or anything on any adjacencies?
All plants, in any major plant, whether it's a power plant or it's a refinery, it's a petrochemical, it's a semiconductor industry, it's a nuclear plant, it's a pharma plant, you require almost 10 to 15% of the capex for any of these plants will go towards piping only.
Sir, I understood. My point was, like in your presentation on slide number 12, you have mentioned that you do heavy fabrication, then you do tanks, storage vessels, silos, those kind of things. So
heavy fabrication we are already doing in our subsidiary called Fabricom. The Fabricom Private Limited, we are doing heavy fabrication. We are doing the wind tower fabrication. That's a separate subsidiary altogether. But our primary business remains in terms of pipe spools and skids only, and pipe fittings. Pressure vessels, whatever we have shown is, we are making it just for our in-house consumption only, for our skid business.
Okay. And just last one on the power side. I mean, you have explained in detail. Is it possible for us to get out of this PPA and go fully on merchant? Merchant power, or sell it through the power exchanges?
It's not viable. It's not viable because we are into biomass power, so where we have a lot of fuel costs. But that's viable nowadays for people like wind and solar, where there is fuel power is involved into that. And we have many other operational expenses where those expenses do not come in picture for solar and wind, and hence it's not viable. Our viable rate itself is around a little above 4.5 to 5 rupees.
Okay.
Just break-even rate. I'm saying just break-even rate.
Break-even. Okay. That's all from my side, sir. Wish you all the best.
Thank you.
Thank you. The next question is from the line of Sanket Thakkar, an individual investor. Please go ahead.
Yeah, thank you for the opportunity, sir. Sir, we initially, planned for a fundraising for incremental working capital, meeting for higher order appetite. Now, in terms of, sir, next 2 years, let's say we are at 1,300 crore order book in December, and incremental 300 to 400 crore you mentioned is in pipeline. So, basis closing March, we should be around 1,300, 1,400, right? But for FY27, to be at, let's say, 2,000 crore order book, how we are planning to meet, those fundings, sir, and how that appetite will come?
It will come from our improved cash flow only. It will come from our improved cash flow only. We do not anticipate any new debt. If all of a sudden, let us say, orders worth 1,000 crores come or something like that, then we may have to. But otherwise, if the orders come progressively throughout the year, then, we won't require anything because of our internal cash accruals only.
Okay. So immediate, let's say, 50% to increase the order book of 50% should not be a concern, right? Our balance sheet will allow that.
That's it.
Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Krishan Lalit Bansal, Promoter, Chairman and Managing Director of D Development Engineers Limited for closing comments. Thank you and over to you, sir.
Thank you everyone for joining the call today. Our performance this quarter reinforces our confidence in the business and our strategy, and we remain focused on execution, capital efficiency, and long-term value creation for our stakeholders. Thank you once again. Thank you everyone for all your questions, and we hope you are all satisfied with our answers. And if there is anything, we are always open for any. We are always open for anything. Thank you so much.
Thank you, members of the management. On behalf of D Development Engineers Limited, that concludes this conference. We thank you for joining us, and you may now disconnect your line. Thank you.